What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 2 additional trade ideas to share with you, so definitely stay tuned for that. You can probably hear in my voice I'm slightly congested, so for any new viewers, I apologize in advance, and we'll keep it short and sweet for today's episode. Before we dive into the price action, I would quickly plug that anything we're associated with is linked down below in the description. Without further ado, let's dive right into the SPY weekly time frame chart. What do we see here from a price action and structural perspective? No fancy intros or anything on today's session. Notice that from a structural perspective, certainly a solid green-bodied bar. The most important part being that we closed at the highs of the weekly range. You could read into the lower wick and just say that, yeah, when there was an attempt to sell it early on in the week, the buyers bought it right back up, and again, we closed strong on the weekly session. We do know, though, that this was a shortened holiday week. The most important, or obvious giveaway, rather, would be the fact that volume was so light. So we're not going to read into it, all that much and say, oh, wow, what a bullish candle, right? In terms of location, we did produce on the bar-to-bar count a higher low and an equal high, which kind of keeps the short-term trend in the upward direction. But we know that the long-term trend, right, if we go from here to here, we've got lower highs and the possibility for a lower high really anywhere underneath the weekly 50 SMA, or perhaps a little bit more objectively, if we do something like this, our resistance trend line. However, of course, that would imply a little bit of upward room to run into the coming week if we're truly going to make it all the way there and then roll over for a weekly lower high. Some other important things based on location, if we draw in our SPY 390 level, which we remember as prior support, then flipping to resistance, support, resistance in that upper wick, resistance here, support in that lower wick. We did technically print out another week's worth of price action above that area, but remember, as I pointed out earlier, it was a shortened holiday week, so I'm not entirely convinced that it's all that bullish of a piece of information. Let's take a look at our volume profile here. What do we see from this perspective? Remember that this high volume node underneath us is basically that SPY 390 level that we were just looking at. We spent another week above. We've closed inside the low volume void, and from a volume perspective, the next overhead target would be the high volume node much closer to SPY 420. Again, not making the argument that we go here in the coming week, but it would seem to be a next valid area of resistance or hang up if the market does continue to move higher. Remember, markets do like to go from high volume node to high volume node, so it seems reasonable that, again, something like this would also coincide with that resistance trendline touch. Let's take a look at the daily time frame chart and see what else we can discern from a price action psychology and location perspective. So there's the 50 and 200 SMA. 50 is blue, 200 is green, and there are our price levels. Beautiful. So from a weekly expected move perspective, certainly look and notice that this is bullish, right? Technically, this is implying the options market is pricing in either a higher high or a higher low from here to here, right? So that does keep the daily uptrend intact. Speaking of trend, the uptrend remains intact, noting that this was ultimately a look below and fail of this balanced range. Look below, fail, targeted the top end of the range. That target was hit. So this trade is essentially over, and I think now it's time for some patience in the S&P 500 to determine how this balance area right here ultimately does resolve. The upper edge is 403. If we break that, we're looking to rotate through the gap and into that weekly resistance trend line, much closer to a gap fill around 408.50 and the top and upper edge of the weekly expected move. If we just stay remaining in balance here, again, it's not really going to offer us too much from a overall market movement perspective. Sure, there will be intraday scalps to be had back and forth, but not all that insightful, and obviously cracking underneath SPY 394.50. 394 is the lower edge of the weekly expected move, does put into play a little bit more of a double top look, right? Certainly something that could be like this. Remember that it's not a double top until it is, which would mean we would need to take out that neckline here for the market to sort of play out in the bearish manner and give us that next lower low, right? So don't assume it's a double top until it actually becomes one. Some things that I would read into ever so slightly from the bulls perspective. Notice that on Monday, we undercut the low of Friday and then rally back into the range. That does strike me as a failure from the sellers to really materialize underneath that Friday low, right? If the sellers were going to make something happen there, it should have been a rotation here. Simply didn't happen. We opened on the gap up on Tuesday session, fill that gap and reverse, which also strikes me as a bullish takeaway. If the sellers were going to make it happen, they should have capitalized on the gap fill momentum and then continued underneath SPY 394.50. Just simply did not happen. So I am seeing some slight bullish evidence from that perspective. But again, I think it's a patience play and really waiting for the next market move to be developing either outside of the balance over 403 or underneath the low of balance at 394.50. What else can we see here? Let's go ahead and throw on our anchored VWAPs. I thought this was interesting from last week and it was well received. So here are some anchored VWAPs coming from the low of 2022 here. Obviously, we're well above that anchored VWAP. This is from our last trendline touch. If I scrunch this up, you can see the anchor is up there well above that, acting as support as well. And the most recent addition is anchoring a VWAP from the CPI gap up. That was, of course, here, that green bar right there. And notice that that is acting as confluence of support down towards the bottom end of the range. And all it would also tell us is that anyone who's really initiated a new position, or a majority, right, averaged by volume, a majority of people who initiate a new position after CPI are feeling good about that position, confident about that position being above that anchored VWAP. So that also does strike me as a slightly bullish indication. Let's take a look at our Fibonacci perspectives coming from the low, of course, to the high. I would just continue to point out that we're well above the 38.2, which does strike me as a bullish piece of information. If this does play out as a double top and we crack underneath that neckline, this, of course, would be a target, the 38.2, and we're also getting confluence of support there with, both anchored VWAPs from the low and the last trendline touch here, but more importantly, a gap close from that CPI move. It definitely would do some damage to the daily trend that's been firmly up for the past little bit, but if we were to get a bounce off of that, I would say that the overall trend, low, higher low, could technically remain in play. To get there, though, obviously that would be some downward price action. I'm not seeing it based on the evidence of how we've closed out the last trading week up here. I'm not just suggesting that we do something like this, but I'm just pointing out that this would be an extreme area of interest right around, what's the level? Let me clear this up and just give you the gap close number, 381.25. If the market were to go down here for some, particular reason in the upcoming week's worth of trade, I would be interested in seeing if we find buyers around this area right here. So that's the Fibonacci perspective from that location. And if we come in from the high down to the low of this most recent downdraft, right, notice that we are getting some price acceptance over the 61.8. Again, these are two holiday trading sessions essentially, so I'm not going to read into it too much. But remember, the more times you can close daily bars or any bars above any 61.8, the greater the likelihood is that you do see that 100% retracement, which would bring us much closer to SPY 431.37. Again, not calling for that this upcoming week, just looking at the data points, more candle closes above the 61.8 do strike me as being more bullish than bearish. That's roughly 400 just for round number's sake. If we can close more candles above 400, looks good for the move ultimately over time, closer to this prior pivot high from way back up in here. So that is our S&P 500 on the daily time frame chart. Let's take a look at our market internals. Again, I don't want to overanalyze this on a shortened holiday week. This is a pretty cool new study that we've just added and came up with. It's the cumulative volume, just totaling everything throughout the course of the week. And what I would point out, if we just look at the weekly volume, again, it was a shortened week, but the inflows were certainly positive, making them inflows in the first place, but they were very mild. It's not like we had anything really impressive up and over like 10 billion per se. You can see that off here, just cut off on the left-hand corner of the screen last week, right? Just to sort of give you an idea of how the tool works. As we were consolidating, we got very mild outflows. It's not like there was any major divergence there, right? So as the market's going sideways and even as we're getting outflows, we can chalk it up to healthy consolidation as opposed to, an outright divergence. If this was, again, closer to negative 10 billion on the outflows, that would be a bit more concerning. So I am seeing some positive, indications from a volume perspective, but again, take it with a grain of salt, being a holiday shortened week. Same thing with the advanced decline line, only getting negative on the Monday session. The remainder of the week was positive. And I would say the same thing about the ticks. Let's not overanalyze it. I would just say on the gap fill day and then reversal higher, that Tuesday rally day, it was supported by strong market internals. So it's not like there's any major divergences happening underneath the hood at this point in time. Let's take a quick peek at our market profile. Again, the main point of this right here is to show you the undercut of the Friday low. So that's Friday's low of not this past week, but the week before that. Monday, we open up, undercut that and put in some single prints there, and then rally. The point of control is back above that low of Friday, which is essentially the equivalent of that daily balance area low in your S&P 500. From there, of course, we rally. We know the rest is history. There's no major, discrepancies here in terms of poor high, poor low. Again, really light volume on both of these trading sessions in here. Wouldn't read into those too much. If anything, and there is a move lower, maybe a tag up to this point of control around 39.85 strikes me as reasonable. That's basically the midpoint of the Tuesday session and does keep us contained within that SPY daily balance that we were just looking at. So not really seeing any major causes for concern in the market profile. Let's get back on over to the charts, and all I'm going to do is remove those anchored VWAPs here. So just back to the 50 and 200 SMAs, and we'll take a look through some sectors to see if there's anything concerning happening from a sector perspective. Again, I'm going to try to keep it fairly brief because it was a holiday light volume week last week. We don't want to overanalyze that, right? Certainly the XLV did put in a solid move to the upside, breaking out over these highs. So all I would say about this is even if we do get a pullback, it would support the idea that the market here in the healthcare sector would remain bullish. This is the second heaviest weighted sector. So this is, chalks up as a bullish data point for your S&P 500. The concerning look would be price acceptance back down underneath 133.50, again with a strong close up here. Wouldn't forecast that as being a likely possibility, but keep an open mind given, again, the shortened holiday week. We're not sure if that price action will hold all that firmly. XLRE putting in a nice little, higher low pattern here after the inverted head and shoulders. It does look like it could resolve higher, especially if we see that rates continue to go sideways or even come in a little bit in the downward direction. So I just watch 39, lightweight sector, not going to make or break your S&P if it does move higher or lower. The only time to really be concerned about real estate is when it's making new lower lows or new higher highs, and just being in here, again, does not really strike me as too much cause for concern. Financial is definitely a little bit more cause for concern, getting a bit extended here through this area of resistance. Again, on holiday trading volume, really light tapering volume, we're getting this push through resistance. Are people going to come back to the screens on Monday and sell it off here, take some profit, and move this back down towards the low end? Remember, it's not a double top until it is. So if it is going to turn into a double top, apologize for the Zoom issue there, but it would have to be underneath 34.80. So I would just watch this and say, okay, first step is, does this turn into a look above and fail? And if so, then we can target the neckline. That keeps us bearish in the short term, which of course would be some downward pressure for your S&P 500. If we stay above 35.75, no cause for concern here in your XLF. Utilities, a little bit of a rally here into the latter half of the week. Notice that we pick up aggressively over this breakout point. We've got thin structure from in here, so it looks like it can continue to make that rotation all the way up here to where the breakdown originally stemmed from at 73.50. Remembering that utilities are D for defensive, this is not really a great look for your S&P 500. What the S&P would want to find more of a firm bottom would be at this point, it's a bit of a stretch of the imagination, but a look above and fail, and then just chop around in here with the solid close on Friday and even the Wednesday session there up and over that 68.78. This is starting to look like a cause for concern. We'll see that on the ratio grid in just a moment as well. Industrials, this has really led the rally, right? We've been talking about this, and again, we'll see it in the ratio grid momentarily, getting a bit extended just like your XLF through a known area of resistance. Are they going to wake up on Monday and sell it back off into this range from in here? It certainly does strike me as a reasonable possibility. If that does happen and we see a pullback in the XLI, that too would be cause for concern for your S&P 500, noting how much the S&P has relied on essentially industrials to continue to keep the broad market afloat essentially and keep things sideways at the highs, right? So keeping an eye on industrials. Next up is XLB for materials. Same idea, a little bit less concerning, noting that it's such a lightweight sector for the S&P, so I wouldn't read into this one too much. Remember, if it is going to turn into a double top, wait until it's actually a double top, and we're filling this gap down underneath 78.50 for now. Really just strikes me as neutral. I wouldn't read into it too much for your S&P. Here's where things start to get a little bit more concerning. XLK, it is doing a decent job of staying outside of this original range from in here, right? However, it didn't make it all the way to the high. It's not threatening to close that gap overhead. We had a really lackluster day on Friday, whereas the market was kind of a little bit higher up in that Wednesday range, right? So I'd keep a close eye on this. If it stays in the balance area, then just like your S&P, it's going to be a patience move either over the top or under the lows. But because it's lagging, if this does start to come back down underneath that 129.50, 130 area, definitely a big red flag for your S&P 500. I would continue to keep an eye on this, especially with what's going on with rates, right? Rates are stabilizing, even coming off a little bit. If the XLK can't materialize on that type of, relief of pressure from the rates, right, then that is a cause for concern. Again, red flag here for your S&P 500. So continue to monitor it. For now, it is just neutral until proven otherwise. And I would say that, yes, we've got lows, higher lows, possibly. It is building out a new uptrend here, especially with higher highs and higher highs as well. But it's got to continue to get in gear and start to pull this market higher. Remember, we've been talking about rotations. I'm not entirely seeing the rotation just yet into things like tech. And take a look at communications. It's going to be very similar, right? It can't get out of its own way. Even with rates stabilizing and weakening a little bit, this has to break out and play quote unquote catch up to the remainder of the sectors and really pull its own weight. It's not doing that so far. It's still stuck in this original balance area right here. I will say it's getting a little bit of price acceptance in the upper distribution of that balance, which is a step in the right direction, but really got to get up and over 50.75 with some price acceptance moving in that upward direction. So this does continue to strike me as another one of these small red flags for your marketplace. Same thing with the XLY, even more of a red flag, honestly. This is a bigger red flag, right? This one might look something like this simply because it's not even in the upper half of the distribution, right? The XLC is at least up here. Notice that the XLY is stuck down below. So growth is just not, it's not getting the love. We're not seeing that rotation we need to see to keep this market afloat. So continuing to see some red flags under the hood from a sector distribution perspective and, relative strength, relative weakness, defensive versus non-defensive, right? Aggressive. It's just not all there. It's not adding up for just blatant continuation in the S&P 500 just yet. That is subject to change if we see a pickup in discretionary communications and tech. But as of right now, it hasn't quite happened yet, right? XLE getting some price acceptance at the top of its range in here. Remember that this too is D for defensive. So if it perks up, not a great look for your S&P 500. Ideally, for equity bulls, you want to see this underneath 88 and, just chopping back around in this general area. Next up, last but not least, we've got the XLP. Remember that this too, I know it seems like, Walmart, Target, all this stuff, great, good companies, they're rallying, right? It is technically D for defensive being, consumer staples here. And it's continuing to chug higher, right? This is powering the move and the hold, you could just call it, in the S&P up at those highs. So if this pulls back, then okay, it's fine. It's possibly putting in a higher low, but this is a defensive sector. You don't really want to see it leading any sort of market charge. So just to sum it up, let's take a look at our ratio grid. I think that this really just continues to do such a great job of showing us, the path forward, risk on, risk off. If you don't know what this is, top right-hand corner shows you how to set it up. But look at the top four, right? This is the risk on segment of our sector lineup. XLK did okay, right? It's coming back above that 50 SMA. That's the gold line here. So it's starting to show some signs of improvement, but pair that with an XLY that's just falling off of a cliff. XLY has to pick up if this market rally is going to continue. And again, I'll show you a reason for that momentarily here. XLI continues to look good, but remember, if that turns into a double top and we pull back, we lose some strength here. Not great for your S&P 500. XLC, it's trying, but it's still sideways, right? Kind of falling more closely aligned with that XLY category in here. Consumer staples continuing to put in just a bullish look with an ascending triangle here. A breakout of that pattern would not really be great for your S&P 500. Energy is holding up just fine sideways. You want to see this trend lower. Utilities perking back up. So remember, the bottom four are the risk off sectors. So to see these things looking good, not really ideal for your S&P 500. And if we just do something like this, I'll show you the yearly looks, right? What I want to point out is roughly the August rallies, which are going to look something like this. If you just look at this segment here, and then if we find the August rallies from in here, that looks something like this. Remember that XLK wants to lead rallies. It happened here in August, not happening in the current look. What is happening in the current look is that the XLV did not lead the August rally. It is leading the current rally. So if we see weakness there, big cause for concern. Same thing with financials. Pulling back here, really what's been driving the rally currently. XLY drove the market rally in the August move, not playing, not even close to a more risk-on look in the current and present day here. Notice that industrials also driving the move higher. So if this pulls back, if that turns into a double top, that is cause for concern, right? Communications kind of flatten, I would even say down in the August rally, but they're certainly not helping whatsoever in the current look. XLP trending higher in the current move and lower in the August rally. So that's not a great look, right? Just overall, when you do a compare and contrast, it doesn't really seem that the market is, on all that firm of a footing. Now, it doesn't mean that price can't move higher, but it just would be a little bit of an echo of caution, so to speak. Let's take a look at another useful ratio that's been helping us over the past couple of weeks here. This is the XLY, so growth compared to value. Notice that we are back down underneath that 1.88, which was the prior floor from here. And this too is just an indication that, hey, use some caution here. Usually we want growth leading the rally, not value. You can see again, if we just do a quick compare and contrast, there is August. You can see that your growth was leading the rally. If we look at the current move in the market from here to here, not the case whatsoever. So continuing to exercise some caution based on these ratio charts that we've continued to point out here. Doesn't seem that the market's all that ready to just flip into full-blown bullish continuation mode continuation mode. However, we're not going to argue with the price action. If we do break out of the range, we'll at least look for some upside scalps. You know, we just talked about that on the SPY daily chart, but we'll do so with a little bit more of a cautious slant. Let's take a look at the dollar, because this too is starting to stabilize, right? This is going sideways in here. If this does perk back up, remember 105 is a really strong area for the dollar. Prior resistance when broken, then proved as support. If this perks up and we find support at the 105, that would not be a good look for equity bulls, and this, you know, probably would mean your S&P comes in a little bit. Now, if you want to play this based on a classic pattern, bear flag, fine. A breakdown of 105, that is what the equity bulls want to see. So I'd continue to monitor 105 really in your dollar here for the next potential forecast of equities and what the signal could be there. Let's take a look at the TNX charts now. This, of course, we'll bring up the signal study because I think this is kind of interesting, right? We got a cross in our rate of change underneath the zero line here, and that usually signals, or it has signaled, right, bullish rallies in the market. You can see when it crosses above, bearish rally or bearish breakdowns, you could call it, in the market. We've just gotten our cross and we haven't really moved aggressively higher yet since the actual cross date. So it could forecast some more upside here in the market, but look at what's going on with that rate of change. If that crosses through the zero line, meaning that the rates start picking back up here, that of course would be some cause for concern, noting that we already have a weak technology sector. All it would take is a kick in the butt for the rates to get back in gear in the upward direction. That of course would not bode well for your S&P 500. So continuing to monitor this blue line down at the bottom very, very closely. We're going to have a very important week upcoming here from an economic data perspective, and the market's really been moving recently just, you know, based on the Fed's expectations from the economic data that comes out. Notice that we get ADP non-farm, we get the preliminary GDP, JOLTS has been a really important one for the Fed. They've explicitly said they're monitoring that, right? We get Powell speaking at 1:30 on Wednesday, PCE coming out on Thursday morning. That's what the Fed uses to measure inflation. We're getting the hourly earnings, the true NFP, not the ADP version, and then unemployment rate on Friday. So a stacked week of economic data. Let's see if this actually moves the needle from a rate anticipation perspective. As of right now, right, we are pricing in more of that 50 basis point rate hike here. If we go out to the next meeting in February, another 50 basis point rate hike, giving us 100 basis points into February. March, take a look here. You can see, boom, we're getting a 25 in March and then another 25 here. Holding steady into the May move. June stays steady as well, holding there at 500 to 525. July, same thing, holding steady. And the first decrease in rates actually comes, or is expected to be priced in currently, based in September of 2023, right? You can see rates are actually projected to come down by that 25 basis point move there. So a Fed pivot on the horizon for September of next year. It's certainly a possibility. Again, the only reason I bring this stuff up is to sort of forecast what the market's looking at. If these numbers all of a sudden shift in this direction and all of a sudden rates will be higher for longer, market probably doesn't like that too much. You see your XLK come in aggressively, which would really correlate with a lower S&P 500, right? Noting that it is the first heaviest weighted sector overall. Some other indications that we possibly have, topped here in terms of inflation. This is a graph of the shipping rate from a container from China to the LA airport, or LA ports in general. This, everybody was talking about this, but notice, boom, all that entire move, I don't want to say it's completely undone, but we're getting very close to pre-mass inflation levels, shall I say, which would be a sign that, hey, based on the transportation theory, inflation could very well start ticking in the downward direction and not look back, noting that the cost to import goods is actually moving lower. The other thing that we would at least have to consider, right, is that what if the Fed has gone too far, right? So this is a look at the current earnings beats versus misses, and you can see right here, the beat rate is about 56%, which is actually underneath the average of roughly 66% per quarter, right? Usually 66% of companies beat, and as of right now, we're getting 56% of companies beating, which is underneath the average. And all I'm saying is that if the Fed has gone too far, and essentially this is going to continue to ripple out into equities, and valuations are going to come down because we're going to continue to see those higher rates, and the Fed has overdone it, so to speak, then what I think we have to keep an eye on is the next possible chart. Here, the TLT starting to outperform the S&P 500, right? As of right now, or before we go to the current look, right? All I would point out is look at the divergences that happen here. So equities are coming in, and relative to equities, bonds become much more attractive ahead of the '08 crash, right? All I'm saying is that this is much more of a defensive look when bonds start to become attractive. If we look at the current situation in the markets, what you would notice is that we're not there yet, right? We're certainly not there yet by any stretch of the imagination. This is continuing to move down as we're moving down in equities as well. But if this starts to uptick and equities do not follow, and all of a sudden your ratio starts looking like this, much more of a cause for concern, because you can clearly see a flight to safety, which would certainly not bode well for equities themselves, right? Noting that investors are probably fearing something like a valuation collapse, an earnings recession, so on and so forth. So keep that in mind here as we're looking at the TLT. And this blue line here is TLT in relationship to your SPY, right? So if you wanted to type it in manually as a ratio, that's kind of what would do it, all right? That is this right here. Continuing to move down, though, not a cause for concern yet, but keeping an eye on this one. Let's take a look at our HYG divergence. This was something that we've brought up in the past, and all I want to point out is that it did not play out. Notice that we had the higher high here, and we finally have the higher high here in the HYG. So this is no longer really a cause for concern. Now we've got high, higher high, we've got high, slightly higher high. So we'll continue to monitor if there are any developments in that, but this is off the table for now and not really much of a risk in the present day. Let's take a look at our SPX A200R. This is percentage of companies in the S&P trading above their 200 SMA. Remember that to avoid the '08 look, we wanted to see some firmer price acceptance over, or just indications above, the half mark, meaning 50% or more of companies are above the 200 SMA, and we certainly have continued looks that are much better in this indicator, right? You'll notice multiple weeks of price acceptance, not really price, but of acceptance above half, as opposed to here in the '08 case where it was just a rejection for a move lower. So this would actually bode well as a bullish data point, but continue to determine whether or not we move into that earnings recession or not, noting that we're starting to miss our average of the earnings beats, right? So if that continues to be the case and guidance comes down because of what interest rates are doing, that would not bode well for the market. But so far, this data point right here does strike me as being more bullish as opposed to bearish. Let's take a look at some volatility products and see what's going on from that perspective. Here's the VIX. What I want to point out about the VIX is that we're at the 2050 floor. This is a step in the right direction. However, from a technical perspective, right, 2050 tends to act as support. We've bounced off of it multiple times in the past. So depending on what the economic data does this week, if the VIX bounces here, okay, we probably know that there's more pain in store for the equities market. So watch 2050. If we don't really get aggressively underneath it, if we just start, trading sideways here around it, the market's probably, quote unquote, holding its breath for this economic data. And even the slightest look at some bad data, this could start popping back up again, and your S&P could start breaking down underneath that neckline that we were just discussing. It's not bearish until it actually is, but as of right now, just watching the VIX around this 2050 to see what the reaction is. If we go one layer deeper, this is actually slightly more cause for concern type look. Remember that the VVIX has been at these historic levels recently, but it's actually perked up into the end of the week, whereas the VIX continued to move lower. So were there starting to become some positions being entered into the market there to hedge against the upcoming economic data coming out this week? Certainly would seem like a possibility given the past 3 trading days in the VVIX itself, perking up here and not staying depressed, even as we had a volatility VIX itself read that was lower. So just a little bit of a slight divergence worth paying attention to. Let's take a look at our Contango versus backwardation read. That's, of course, here in our VIX futures, continuing to fall off of a cliff, which is exactly what you want to see, indicating more risk in the future as opposed to the present day. So money managers are content with outlaying some capital there. Let's take a look at the remainder of the broad market. Thank you so much for sticking with me through the deep dive in the S&P 500. If you enjoyed it, feel free to drop the video a thumbs up, leave a comment down below, all that good stuff. Consider subscribing if you haven't already. And again, for any new viewers, apologies for the stuffy and congested sound. Here's the QQQ, really putting in some solid work above the original balance here, building out a new look there. What I would say about this is very, very important. Remember in last week's episode, we talked all about not this past Thursday, but of course it was Thanksgiving, the Thursday before that, the low being very, very important. Just like in the S&P, we undercut that low on what would that have been the Tuesday session, and then rallied back above 283.50. So a slightly more bullish indication than a bearish one, noting that the sellers did not take their stand underneath that Thursday low there. Overall, we are still stuck in a sideways sideways balance. So just like the S&P, I would wait for a move here or a move there to start to forecast or tell us what the next move might look like. Some inflection points would be 290.50 and the low end right here at 281.25. Overall, the weekly expected move keeps us in a neutral trend, suggesting that we could get a higher high or a lower low. So really keeping a close eye on the QQQs. Ideally, buyers want to see it stay above 283.50. And with that undercut and failure from the sellers, I would say that there's a slight bullish edge here in the QQQ. Let's take a look at IWM, Russell 2000, and the small caps. What do we see over here? Noting that we certainly have a little bit more of a bearish look, right? On the intraday, like if we go to an hourly chart, you can see this a little bit more cleanly. This certainly was a double top. There was your neckline. We did get a majority of the price action accepting underneath that neckline, and only on the Friday shortened trading session did we poke back above and get some price acceptance above that level. That number is 80. I would continue to monitor. Can we spend some more time here instead of coming back down underneath? This is continuing to signal again a bit more of a red flag. Maybe it's not a quite maybe it's a yellow flag, right? Exercise some caution out there in the equities markets, because don't get me wrong, it's still obviously in a clean uptrend with lows, higher lows, higher lows, higher highs, higher highs, higher highs. It's still in an uptrend, but the fact that it's not consolidating here and we did get more price acceptance underneath that double top neckline around 184.80 is just a slight cause for concern. So if this does turn into an inverted hammer breakdown underneath Friday's low, move to here, that, of course, would have me feeling skeptical about rallies in the S&P and even the QQQ. Remember that IWM has been acting as a market leader. Just to illustrate these guys side by side, here are the weekly charts all next to each other. Notice that we talked about the green S&P bar there. The QQQ undercut the inverted hammer low but closed back inside. So an inside bar here. Again, we will learn something about this market when we move outside of this range, either here or here. We talked about those inflection points. And the same thing with our IWM, an inside bar. But overall, you'll notice that the majority of that candle body is underneath that 184.80. So a slight cause for concern, yellow flag, as we put it in the IWM. Let's get into the core list of companies now and see what's going on from that perspective. Again, no fancy edits or intros or transitions or anything in this week's episode. Keeping it hopefully short and sweet with no major distractions. Apologies once again for the voice. I know how annoying it can be to hear someone who sounds congested, but we're powering through. Hopefully the information is valuable. Breakdown of the bottom of the range here at 147.65 is your sort of cause for concern for bulls in Apple, right? Noting that we've got from here to here lower highs, breaking down underneath that, catches everybody off sides, to use a World Cup and soccer reference, right? Catches everybody off sides if we break down who is positioning for a possible daily bull flag, right? Because certainly the pattern would suggest, okay, break out of the top, and we are in store for an upside move. If you position long and you're holding, you probably have a stop loss underneath some of these lows in here. So 147.65 is the gatekeeper on the downside. For upside action, you need to see price acceptance over 149.75. Here's the hourly time frame chart, and you can see clear as day that's where all the intraday reversals had been coming from, right? Boom, boom, reversal back higher, failed resistance, support here for the move that looked like this, breakdown. It goes without saying 149.75 is the first step in the right direction for the buyers, price acceptance here and then a breakout. But for now, certainly the cause for concern is a move underneath here to rotate back down to 143.50. So that's Apple looking slightly more bearish than bullish, not closing the overhead gap here and just remaining low and weak in this overall range, whereas the S&P is certainly a little bit more high. Next up, we've got Netflix. This chart is continuing to be a little bit more perplexing. If you just think about this as the original range, it was really sloppy, but lows, highs, right? We made a higher high, we made a lower low. So there's a lack of trend happening here. I would say buyers, if they are looking for this to be a higher low pullback and see continuation in the upward direction, it's got to be over 292.50. Again, here's your hourly time frame chart. You can see clear as day, intraday reversal here, rejection, rejection, rejection. If we can recapture that, certainly starts to look better for the bull case into 303. So that would be my upside look for Netflix cracking 292.50. Any consolidation here is neutral at a breakdown of 278.75. The lower wick from that reversal bar here is where the bears start to feel more comfortable to the lower edge of the original range at 265.25. Next up is Tesla. Looking for some bullish action in Tesla here, although the weekly trend is so firmly down, right? Technically speaking, we have a balance range, and we got a break, retest, and move lower. But this time, instead of getting a break, retest, and another move lower, we've actually accepted back within the original range right here. So look below and fail is on the table. As long long as we're above 177.12, again, here's your hourly time frame chart. Look at that intraday pullback, just right to the level and then rallied, right? So as long as we're above 177.12, good to go. You can continue to monitor for that true look below and fail target, which is, as we know, always the top of the range at 195. When and if we get here, time to reevaluate the chart. Definitely the weekly time frame trend is firmly down. I would possibly continue to monitor for a lower high here and then another fall apart inside of Tesla. So one step at a time, but over 177.12 looking more bullish than bearish. If it falls back down underneath the range, different story. You'd have to see how the breakdown ultimately takes place at 177. I wouldn't just short it on the first break. Next up is GOOGL. What's going on with GOOGL? Just sideways stuck in a range. We'll keep it very, very simple here. Look below and fail. Technically, it should move to the top, but really, you're just waiting and being patient for the possible gap fill overhead. Over $100.10 fills up to 103. If we were to break back down, okay, underneath 96.50, game on for shorts. Probably don't hold after a lower high here. You could call it a lower high double top, right? Remember, it's only a double top when it is. Underneath this neckline, you're gunning for this gap down underneath us. 91.59 down to 89.49. Next up, Metaverse. What's going on with Zuckerberg and his fantasy land here? Certainly stuck in a sideways balance, just like a majority of things actually stuck in sideways balances. You're going to want to watch 114.50 and 109.30, either over or under. If it's an under, you're just making the rotation back down to 104, retracing all of that, excuse me, my apologies, that rally from right around in there. Of course, overhead, I would watch for something like this, honestly, and only really be interested in playing for that overhead gap if we have the general support of the entire broad market. If we don't, not all that enthused about Meta upside. Next up is NVIDIA. Certainly some relative strength here in NVIDIA. It goes without saying. I mean, look at this chart, so firmly above its original balance area. Reasonable pullback. Higher low has been established here. As long as we're above this 162.50, you can start to see this as a bit of like an hourly bull flag, a 3-bar play potentially. Not the greatest bar. It's an inverted hammer on Friday's session. But if we can just consolidate out sideways and really stay above, I'd call it the Wednesday session low. Here's the hourly time frame chart, right? If we can stay above kind of this zone right around in here, 162.50, 162, great. Looking for that continuation move in the upward direction. Failing that, and you can see we've got generally thin structure through that breakdown and breakout here. There might be a bit of a hang up around what would this be, closer to 158, but ultimately the target would be closer to 154, right? 154 on the NVIDIA downside should we break down underneath and get price acceptance underneath 162.50. So that's NVIDIA looking the most bullish of all these charts. Microsoft is a close second, right? Just simply because here's the balance range, look below and fail, move to the top of the range, great. Again, not the best looking candle on Friday with the inverted hammer, watching for a higher low pullback, ideally above some of these prior rejection points in here. Maybe the hourly chart does a better job of showing that level. Look at that, clear as day, right? So right around 243.40, we'll call it just for round number's sake. You could go back and finesse that level and figure out exactly what it is, but higher lows off of that do look good here. Just noting that the daily balance has been holding, mild pullback, and then we can rotate back up towards this area of resistance here, 250.75. Remember, the only time that this gets concerning for a double top look is if it fails the neckline. I would just say 240, back down underneath 240. All right, let's see what we can do with this gap underneath us, 235.15, 228.58. Last but not least, we've got Amazon, the mini beast. What's going on over here? Another one of these sloppy charts, more similar to Netflix and the metaverse play, honestly, just kind of stuck here. I mean, don't get me wrong, the weekly trend is down with these lower highs in play here, but we've got some long-tailed hammers earlier on from this past trading week. I would watch 94.50 as a possible breakout to the upside, just for a retest, though, of 97. Like, you're not really playing with too much of a range here. If we take a look at the hourly time frame chart, I mean, the structure is not thin. It's not like you've got an easy rotation to that next level. You'll note where it's coming from, right? You can certainly see prior resistance and support in here, but it just doesn't strike me as a clean and tradable move there over 94.50. I'd be very cautious inside of Amazon and not look to be overly aggressive in a chart that would look something like this. For downside trades, I would just want to see price acceptance underneath the gap, basically underneath 89.57 for more bearish outcomes. 2 trade ideas, and I'll send you on your way. Hopefully you've enjoyed your long weekend. You had a great Thanksgiving with friends, family, whoever you celebrated with. BA, what a beautiful chart here. Just beautiful relative strength. We've talked about this in prior videos as well. Putting in a nice bull flag, didn't want to break out too early, consolidated beautifully Friday. Again, really light trading volume down here, so we need confirmation. I would not just jump in immediately long on something that looks like this. However, the chart looks good for a possible upside move. Here's a weekly time frame chart. Again, even if you just don't want to read into too much what took place last week, the bar prior to that, we were talking about a 3-bar play. It's still on the table, right? Cracking this, we can get much closer to some resistance overhead, just north of 190. So continuing to monitor BA for some bullish outcomes, also noting that this price acceptance is happening above a weekly double bottom neckline, right? So it does look good here for continuation in the upward direction on BA. If it is going to be a look above and fail, you can look for shorts there and target the neckline, but I would not be overly aggressive on shorts, noting the relative strength to the overall broad market, right? This is just one of those names where you would probably want to favor longs instead of shorts. Last but not least is GS. Very similar concept and idea, beautiful relative strength to the market. However, noting where the XLF stands in relation to its structural resistance, what I would watch for here is a fake break. Can we get a fake break up above and then rotate lower? This is where I would actually look for more of a short into that neckline and possibly a rotation lower through some of the thin structure that we had on the move higher. So GS, yes, as of right now, it is a bull flag and it's looking like it's starting to break out. But if this turns into a fake out, and you'll know that based on what's going on in the XLF as a sector overall, and this comes back lower, this would probably be a prime candidate to look for shorts on the pullback in the overall sector, noting a little bit of weakness there, right? And the catalyst to do that may be something that comes out with the jobs numbers and ultimately how the Fed will react to those job numbers. So that's what I've got for you in this week's episode. Thank you so much for sticking with me all the way to the end. Just a quick reminder, thumbs up button on the way out or a comment goes a long way to show a little bit of support for the channel. With all of that being said, we will be live on Monday morning at 8:30, and we wish you all a green trading week.